Hi there, this is Tom Suvansri, Premier Trust Advisors. Thanks for joining me on this video. You know, in the financial world, there's just a lot of information to be consumed, and people are subjected to figuring things out, what's right for them, and do they have all the information, and it can be a daunting task. And unfortunately, it is our responsibility to figure some of this out, right? Certainly, we can utilize advisors and others to help us, but ultimately, it's our decisions to make for ourselves, for what's right for us and our families and what we value. And so my job and my role in my company here is to help educate people about that, so they can make the right decisions for themselves. And one topic that is certainly near and dear to my heart is life insurance, and it's not the most exciting topic for a lot of people, but it's a really important financial tool that I think everyone should at least know about, understand how it can work for them in their situations, and then they'll have the information to make the right decisions. And there is not a one size fits all. However, a lot of the typical advice tells you this is the only way to do it. And so to me, my joy is to share the full picture so that people are better informed and will make decisions that matter most to them with all the information. And so today I want to cover a topic around life insurance to show that it can be considered more than just insurance. It can be considered an asset, a very valuable one at that. And the easiest way to explain this is to compare it to a house, because everyone either has to find somewhere to live or they rent or own. So there's a lot of parallels into life insurance that line up very nicely to a home. So I'm going to use that as a way to explain some of the mechanics, the pros and cons of them, so you have a fuller understanding. So I'm going to share my screen here. And a lot of this starts with understanding that life insurance is not just protection. There's obviously a massive component of it is protection, but designed properly, they can be a significant asset. So let's just start at the very beginning. And the left side will be your home, and throughout the course of this video, and the right side will be the life insurance policy. And I'm using a permanent whole life insurance policy as the example. And so on your home, you have a $500,000 home. Typically, you're going to put a down payment down 20%, and the bank is going to finance the rest, and you get a fixed mortgage payment through the life of the loan, maybe 30 years. And so that's pretty basic stuff. I mean, you can do some things differently, but by and large, that's what most people do. And so the risk to the bank is that 80% they've loaned to you. Pretty straightforward. On the life insurance side, the whole life insurance side, you have a $500,000 guaranteed death benefit that can only go up. So it's going to stay there. And you have fixed premiums that are locked in through the life of the whole life insurance contract. And so at the beginning, the life insurance company has a significant risk that if you make one payment, then your beneficiaries would get a sizable tax-free death benefit. So that's just the starting point to get it started. And there's additional details to that, but that's the core piece. So when you're putting money into either asset, where do the dollars go? Well, in the house side, when you're making your fixed mortgage payment, a good portion, certainly early on the life of a loan, a lot of it's going to interest to the banks. So obviously, they've given you this money to buy the property, and you only have to put 20% down. And so a lot of the initial costs are going to interest, and a piece of it's going to building up equity, paying down your debt. Obviously, over a course of time, more of the payments you're making are going to go to paying down your mortgage, the loan, and less to interest. So that shift will happen over time. And the equity you're building up in your home, unfortunately, doesn't have a rate of return to it. It's just kind of sitting in the assets. So it doesn't provide you a whole lot of extra benefit other than building up some more equity, but there's no rate of return, so to speak, of your equity. On the life insurance side, the premiums that you're paying into it, a lot of the costs initially will go to paying your insurance. right? Because we said before, the risk to the insurance company is pretty significant in the beginning. So they need to recoup some of those costs, and then they go use that money to invest. And then slowly over the course of time, there's guaranteed cash value that builds up in those policies, slow to begin with, and because of the risk. And so, and the cash value does have a guaranteed interest rate return to it that's baked into the contract. So again, they work very similar in the nature of slow build up. Obviously, the risk to the bank and the life insurance company is sizable at the front end of this, but over a course of time, your equity, so to speak, or cash value will build up over time and become more efficient the longer you're into the policy or the home. So thinking about how to add to this asset, right? You have this asset. And so on the home side, pretty straightforward, because you can add additions to it. You own the property, you can do things to it, add an office, basement, and say you had a $25,000 addition. Hopefully the value of the home appreciates by that much. And now you've built in some additional equity, you've put some money in your home. And so that is pretty straightforward. Unfortunately, a lot of additions don't get all your money back, but let's just assume that every dollar you put in shows up in the value of your home. On the life insurance side, there is a option here, and it's usually not shared for a lot of policies because it's just not something that most people are pushing, but there are options you can add to the life insurance policies that allow you to add more money on top of your base premium. And this is called a paid up addition, and basically buying smaller life insurance policies that are completely paid off and add to your initial asset. And so in this situation, you put $25,000 in, it actually builds up cash value of that amount and actually builds more of death benefit as a multiplier. In this case, it's just 3 times. They can go up to 5 times depending on your age and your health. So every dollar you put into this increases your death benefit by more than 1 times. And this example is even a conservative one, 3 times. So that's how you can add more value to these assets, and then the cash value inside gets a little boost because of your additional premium payments. So let's talk about changes to asset value. So that was one way we talked about adding more to it through extra payments or adding an addition to the home. So in this case, the home value can appreciate just by nature of just inflation, right? Most people think that houses grow with the pace of inflation. So let's just say that does happen. We know it's not always guaranteed. Look at 2008 and 2009. That wasn't very pretty. But by and large, they have grown over time. And because you have leverage on the house, those appreciation amounts can actually be more, right? Because you're not paying the 100% of the cost of the asset. On the life insurance side, the way it appreciates is through some of the things we talked about before by adding our own additional dollars, but you also, because of the types of companies we use, mutual insurance companies, you own part of that company. And so you're eligible for dividends or the profit from the company that are issued and provided by the companies every year. And there's not a guarantee of this, but they've been paying it for well over 100 years, and likelihood they will continue to go forward, but it's not guaranteed. But when they do, then those dollars are yours to keep. You can never lose them. And then one way to do this is when you take those dividends, you can buy, again, smaller pieces of life insurance policies that are paid up completely and add to your cash value and death benefit. So those are coming back to you as a possibility to add to your policies. And early on, I would highly encourage that. Down the road, you can take that money as cash or use it to pay premiums, whatever, there's options. But initially, that's another way to build this asset. So the big part about building this asset, you're building equity on both sides of the equation, on the house or the life insurance. So how do you get access to your equity? Well, the home gets a little trickier because obviously the bank is still trying to protect themselves. So even though you've built up a sizable amount of equity, they're going to hold portions of it to protect themselves. right? In this situation, you have $200,000 of equity. They're going to maintain usually 20% of it, of the home value, to protect themselves. And then they'll potentially give you access to the balance and equity. And they don't have to give this to you. Right now, when there's uncertainty in the economy, banks will not allow this and don't offer it. And so then your home equity is stuck in here until you sell, which some people are not ready to sell yet. So it is sometimes a challenge to get access to it. In this situation, you can get access to about not even half your equity. On the other side, in life insurance, they have a loan provision in the contract that states that you can get access to around 95% of your cash value, no questions asked. It's just part of the contract. And so you can get, in this scenario, up to $190,000 of your $200,000 of equity. And then the only thing that's tied to is an interest rate. And that's depending, there's some are fixed, some are variable, depending on the company you use. And then you have freedom to pay that back when you want to. And so it's flexible. You can pay in big lump sums, you can pay a little bit at a time, delay it. And depending on where you are in your life, you may never pay this back, because what will end up happening is when you do die, death benefit will pay off any outstanding loan, and then the balance goes to your beneficiaries tax-free. And so it's a very flexible tool, and a lot of folks are using this for a banking function because of the flexibility and control it offers, but really a good sort of quality and trade for these life insurance policies. So other than that, I want to share some other benefits of life insurance that are just, they don't come with a home, of course, but but situations in our life change. So you become disabled or you die. So let's take each one separately. So if you get disabled and you can't work, you might get you hopefully have some protections that replaces that income. But unfortunately, what I've seen for a lot of people, they are underinsured in that area. And so they'll get maybe a portion of their income, and so they may not be able to continue to pay their mortgage. And so some people, get into foreclosure, or they need to sell the property just to get out of this obligation and move on. From a life insurance side, there are provisions that you can add to, they call riders, to the policy, so that if you get disabled, a life insurance company will continue to make those payments for you, premium payments, build up cash, all those protections still in place while you're disabled. And if you're disabled long-term, you imagine the benefit of that. And so all the guarantees in there are upheld in those policies. On the, obviously, death side, if you died in terms of your house, then that could spur other things, like maybe needing to sell the property. And that's the only way you're going to get equity into it, other than maybe a home equity line. But if you're no longer here, there's no home equity line to tap into. So you may have to sell this property and then go through all the transaction costs associated with that to get access to it. On the life insurance side, of course, this is what it was built to do, is provide a death benefit tax-free to your heirs. If you have any outstanding loans, you'll pay for that. But a very efficient way. There's a lot of estate planning that can come along with it, but given the tax benefits, it's really a great benefit to have. Now, in terms of other risks that we have going for, long-term care is a big one that people heading into their later years are probably concerned with. And so if you, in terms of a home, that you may need to sell to get home to get some of the proceeds, because the equity, again, is stuck in the home. Or you may just have to drain the rest of your assets before that to be able to fund long-term care. From a life insurance side, there are provisions in most of the policies, and there's even ones that closely mimic long-term care that you can add to life insurance, and you use the death benefit to serve as long-term care. And so if you need long-term care, you can start using the death benefit before you pass, and then whatever's left will be provided to your beneficiaries. So it doesn't require you to use your other assets and drain them. In terms of retirement, obviously a house is one people aren't going to wrestle with because they have so much equity in the home and only could tap portions of it. So some people may get a reverse mortgage, which you can use later in life, and at least you get tax-free access to some of your equity in your home without having to sell the house. But some people will need to sell, want to sell, and then that may translate into a taxable gain depending on how much your house is appreciated. In terms of life insurance and retirement, the great part is build up cash value has never been taxed, and you can start withdrawing money for tax-free withdrawals up to what you've contributed to the account. And then after that, you can start taking loans that are also tax-free and start building up the loan, and then the death benefit will pay off. So then in that scenario, you'll never pay taxes on the money that's built in here. And then the tax-free death benefit is also there when you do pass. So it's really tax efficient tool if understood how to use it for your safe dollars that are guaranteed to be there. Think of it more of a bond alternative, or a savings account that is safe money that is protecting a pretty sizable death benefit on top of it. So I know I covered quite a bit of ground in this video just to give you a snapshot of how it works mechanically and some of the great benefits of a permanent type policy like this. So if you want to learn more about how this could potentially benefit you and your family, I would urge you to reach out and discuss it and see how it could potentially fit into what you're doing financially and benefit your family in this lifetime and beyond. Take care, and hope to talk to you soon.